For a long, long time, there was this one simple rule that was supposed to explain everything about the stock market. Just one rule. But here's the thing. The real world, it just wasn't playing by the rules. So today, we're going to talk about the groundbreaking idea that basically tore up that old rulebook and gave us a completely new and way more accurate map for understanding what really makes stocks tick.
So here's the big mystery, right? The thing that kept the smartest folks in finance up at night for years. Why is it that some stocks seem to consistently do better than others for no good reason? You could account for all the risks you knew about, and yet these certain types of stocks just kept winning. It was this weird anomaly, kind of like a ghost in the machine that nobody could figure out. So what was really going on here?
Okay, so the old rulebook, the official story, was this thing called the Capital Asset Pricing Model. You'll hear it called CAP. And, it was really simple, almost elegant. It said, look, only one thing really matters for a stock's return. It's beta. And all beta is really is a measure of how jumpy a stock is compared to the overall market. Does it jump higher or is it more stable? According to CAP, if you wanted a bigger return, you just had to buy a jumpier stock. Simple as that. Take on more market risk, get more return. End of story. Or at least that's what everybody thought.
But there was this massive problem. A huge disconnect between the theory and reality. The model said only beta matters. But the actual data, what was happening in the real world with real money, was screaming something totally different. Two specific kinds of stocks kept outperforming what their beta predicted they should. Small companies and these things called value companies. The official story was starting to look pretty shaky. So researchers started gathering clues like detectives at a crime scene. First, they noticed something called the value effect. These were stocks that just looked, cheap on paper. They had a high book value compared to their stock price. And for some reason, they just kept winning. Then there was the size effect. Little companies, small-cap stocks, were consistently bringing in higher returns than the big guys. And here's the kicker. Beta couldn't explain why. These weren't just one-off lucky breaks. This was a pattern happening over and over again. All right, so this is where our heroes enter the story. Two researchers, Eugene Fama and Kenneth French. And in 1992, they did something brilliant. They didn't just point at these weird patterns and say, that's odd. No, they built a whole new model around them. They said, these aren't anomalies, these are the clues we need to solve the mystery.
And their big idea, it was actually super simple. They thought, okay, what if understanding stock returns isn't like a recipe with just one ingredient, just market risk? What if it's more like a 3-ingredient recipe? They suggested that there were two other distinct, measurable forces out there that were consistently helping to drive returns.
So here it is, the new recipe. First up, they kept the original ingredient, market risk. Makes sense, right? You still get paid for just taking on the risk of being in the stock market. But then they added those two anomalies as official new ingredients. The second factor is size. They called it small minus big, or just SMB for short. This basically captures that extra juice you get from investing in smaller companies. And the third factor? That's value. They called this one high minus low, or HML, and this captures that premium you get from buying those cheap, overlooked value stocks. So there you have it, market, size, and value. That was the new code to crack.
Okay, so identifying these factors was a huge breakthrough, but it immediately led to an even bigger, deeper question, a debate that's actually still raging today. Why do these things work? Why do you get paid extra for owning smaller or value stocks? Is it because they're genuinely riskier? Or is it because investors are, just kind of irrational sometimes?
And this really breaks down the two competing theories. On one side, you've got Fama and French themselves. They argued it's a risk story. They said, hey, small companies and value companies are just riskier. They're more likely to get into trouble when the economy goes south, so that extra return you're getting, it's not a free lunch. It's your fair compensation for taking on that extra danger. But then you have the other side, the behavioral finance folks. They say, no, it's all about human psychology. Investors get all excited about trendy growth stocks and irrationally ignore the boring but solid value stocks. So the extra return is just the market eventually coming to its senses and correcting those mistakes.
And Fama and French had a pretty strong comeback for that mispricing idea. Their point was basically this. Look, if this was just some simple mistake that investors were making, the pros on Wall Street would have jumped all over it and arbitraged it away a long, long time ago. The fact that these premiums have stuck around for decades, not just in the US, but everywhere, really suggests they're not a mistake. They're compensation for some kind of real deep-seated risk.
But here's the thing. Regardless of why it worked, the fact is it did work. The model's power to explain what was actually happening to stock returns was undeniable. And it's that practical power that went on to completely change the entire world of investing.
Because this model gave us a brand new, super powerful tool. For the first time, we could really answer that age-old question. Is your fund manager a genius, or are they just getting lucky by loading up on small stocks and value stocks and just riding the factor wave?
And this is basically how you do it. You can take a fund's performance and slice it up like a pie. You can say, okay, this chunk of the return came just from being in the market. This next chunk came from their bet on small stocks. And this piece came from their bet on value stocks. And then whatever tiny little sliver is left over, that is what we call alpha. That's the manager's real skill. And let me tell you, for a lot of funds, that alpha slice turned out to be a whole lot smaller than anyone expected.
And get this wasn't just some weird American thing. Researchers took this model and tested it all over the planet. And they found the same patterns, the size and value effects, popping up in Europe, in Asia, pretty much everywhere. The fact that it worked globally was huge. It was massive evidence that Fama-French had really tapped into something fundamental about how markets tick, period.
But you know how it is, right? Science never just stops. The three-factor model was absolutely revolutionary, but it wasn't the final chapter of the book. It had its own critics, and like any great idea, it started to evolve.
Yeah, the model wasn't perfect. Some critics said, hey, maybe you guys just got lucky. Maybe you just tortured the data until it confessed. That's called data mining. Plus, the model totally missed another really powerful effect called momentum, the weird tendency for winning stocks to keep winning. And maybe the most awkward part? That size premium has pretty much vanished in the US in recent decades, which makes you wonder just how persistent these things really are.
But this is where you see its true legacy. The three-factor model basically kicked off this whole new way of thinking called factor investing. It opened the floodgates. Soon, a guy named Mark Carhart came along and added momentum, creating a four-factor model. And then, years later, Fama and French themselves came back and updated their own work, adding two new factors, profitability and investment, to create an even better five-factor model. You see, they started a chain reaction of discovery that's still going.
So if you take away just one thing, let it be this. The Fama-French model's biggest gift to us was proving that the market isn't just one big single thing. A stock's return isn't driven by one single force. No, it's driven by multiple, separate, identifiable drivers. They fundamentally changed how we see risk. It's not a straight line, it's a rich, multi-dimensional landscape. And so that leaves us with one last big question for you. Now that you know that there are these different engines that can drive returns, not just the overall market, does that change how you think about building your own portfolio? It's the powerful, practical question that this incredible model forces every single one of us to think about.